Today I'm gonna talk about owner's capital, debt, how risk is increasing, and what is beta structure and what way to use in different circumstances situation. For instance, if we start from the beginning, if product demand is quite high and company product demand is quite high, owners are inclined, actually they eager to raise debt, borrow, than to raise capital from um, this stock issuance, because they don't know if in the future these returns and earnings and everything will be very high. Nobody wants more partners. Actually, they want less partners and debt, which has lower cost than this cost of capital. Because if you right now, if you issue stocks, shares, and raise capital, it can be very expensive, because due course when earnings and profits rise substantially very high, as owners expect, management expect, then it will be late to think about that you have more partners and you have to share this profit to more partners. Owners. But in this situation, when you have huge expectation with business, great business, most of the owners raise debt and borrow debt, because they want to, as I already mentioned, share profit, and it's actually less costly than owner's capital. You understand now? Yeah, right. Why people say equity is more expensive than debt, but it's not always true, because if your return on investment capital is higher than interest rate, you always want to have actually debt than stock issuance. And if it's higher return on investment capital, then required return. It's very interesting and very good subject, because when you raise, for instance, eventually you require debt, and you raise debt, and so you borrow, and you have capital structures and added this portion of debt, you required risk actually increased a little bit, because I tell you, equity portion, not generally average, as people say, cost of capital generally, it may decrease technically, as in academic books is written, because portion of the cost of capital, portion of the debt on average and weighted average, it brings you somewhere lower when this debt interest rate is lower. It gives you lower cost of capital. But what happens actually for required returning, actually as you add more debt, required return, actually a portion of that increases, because it becomes riskier and riskier. Why? Because you have to pay all this fucking debt, let's say like that, and it became owner's capital more riskier than without debt. But on average, cost of capital, there is some point equilibrium there. It's equal required return and cost of capital, but from the beginning, of course, cost of capital is lower than required return. But eventually it becomes somewhere at equilibrium, some point, some portion of the this owner's capital and debt, where you can't add more debt. If you add more debt, this required return or owner's capital becomes very risky, because if you have huge debt and you have some problem and can't pay this interest rate of that debt, not debt actually, problem of the raising more debt is when you can't pay interest rate, not actually debt itself. And when this happens, we can't pay debt, so liquidation can happen, for instance, for company. And first, all money takes banks and the debt holders and so on, and maybe nothing, small portion left for owners. That's why adding more and more and more debt, it's very risky, and actually required return becomes higher and riskier. You understand what is the problem, yeah? Because big debt is not good. Some portion, some equilibrium, when you adding debt, a little bit debt, or maybe a little bit more debt, there is some point which is best for the company, but nothing more than that. You have to analyze that, because when you add more and more debt, and eventually you can't raise any debt and bank doesn't borrow you, actually you raise capital, yeah, because issuing more shares and to somehow finance your operations, and this is very bad for owners. Actually, they lose value for that company. So that's why it's quite risky to add more and more debt. Small debt or some portion of debt which gives more profitability, and cost of capital is in equilibrium somewhere, and it's good for company, it's okay, but adding more debt is bad for the company. So this is what I wanted to tell. If when you analyze this company value, you have to always watch and think what happens if this and this, and if you see a lot of debt for some companies, sometimes you can find very low value, and you're saying undervalued, something like that. Okay, it's undervalued, and when you look, they have huge debt, and it's quite risky, because for small companies, if it's floating interest rates and increasing this interest rates, like recently Fed increased it, and everyone increasing floating, yeah, your debt expense or interest rate expense becomes higher and higher. It's bad for the company, and can't raise more debt, so it becomes very complicated. That's why just big portion of your capital structure debt, when it's debt, it's quite risky. If something happens with your sales and profit and so on, operating profit, I don't know, share price will plummet, so you must be careful when you analyzing companies and capital structure and so on. Thank you.